Hey y'all, today we're taking a look at the FHA loan contingency exhibit. This is probably going to be the most common loan contingency that you use. Uh, More often than not, it's either going to be the FHA or the conventional loan that you're using. So let's jump right in. And it looks very similar to all of our exhibits in that we fill out our exhibit letter right here, capital A, capital B, capital C, our offer date from our purchase and sale agreement, and the address of the property that we're making the offer on. We're then going to choose whether it's just a first mortgage or a second mortgage. Missing the checkbox here is very common. And you'll see here, it tells you either select A, that it's just a first mortgage, or A and B, it's a first and second mortgage. In today's market, most loans are going to be first mortgage only. So typically you're going to be checking box number A. Now for an FHA loan, the most common loan amount is going to be 96.5%. They're being required to put 3.5% down, so 96.5 is our loan amount. Typical term is going to be 30 years. Our interest rate, we need to get that from the lender, okay? And if we know that it's a long time until we're going to be closing and the client's not going to be locking in their interest rate yet, we might want to give ourselves a little flexibility in this. So let's say that they're approved for 3.0. We may want to put 3.25 or 3.125 in here. What we're saying is if we can't get approved for this loan at this interest rate, that our client's going to be able to back out of the contract and get their earnest money back. So 96.5, 30 years, 3.125%. That is a fixed rate and it's institutional. You see, we do have the option here of an adjustable rate mortgage. We just don't see those very often in today's market, but that's always prone to change. We're going to move ourselves down to our approved mortgage lenders. When working with a buyer, there's absolutely nothing wrong with leaving this space blank. That way, they can get denied from any lender and get their earnest money back. Any lender that we list in here, the loan denial letter must come from one of these lenders. So if there's any chance that your client's going to move to a separate lender, okay, you know that they're shopping the rate, or you don't know that lender and have a relationship and trust that pre-approval letter, you want to make sure you've got more than one lender put in here. And the recommendation is if they've come to you with a pre-approval, put that particular lender in here, but also add your preferred lenders. Add Keller Mortgage and Supreme Lending. Put 3 different lenders in here. So if things don't work out smoothly with that first lender, they've got a couple of options to move to. You can leave it blank, but that kind of leaves things in their court. Things aren't working out with Wells Fargo, then they can move to Quicken Loans, or they can move to Bank of America, okay? And you may not like who they choose. So by putting a limited list in here, you can kind of box your buyer in to where they're either using the lender they've started with or they're using your preferred lender, okay? Continuing on down, we have a certain number of days from the binding agreement date to determine if they have the ability to obtain the loan. What this means is that we have a certain number of days to determine if they are denied, okay? They can get approved for the loan all the way up through closing, and we're going to go to the closing table, and everything's going to be fine. A contingency is there to protect the buyer when things don't go smoothly, okay? So they get declined for the loan. We want them to be able to get their earnest money back, okay? But in today's competitive market, sellers are looking for as short of a financing contingency as possible. However, you want to make sure you keep your client protected. So we want this to be as long as possible. And Depending on who the lender is, the relationship you have, how far the client is through the process, may influence the timeline that you put in here. 30 days is a very typical number to see in here, 28 days. And for most lenders, that's good. However, if your client is using one of the large banks, Bank of America, Wells Fargo, Navy Federal, or if they're using an online lender, Quicken Loans, Rocket Mortgage, anybody like that, Lending Tree, they tend to move slower. And so 35 days is much more comfortable, but don't ever put a number in there less than what the lender has told you. Call and talk to that lender and find out how long do you need to get this loan done. You'll find most of them will tell you 30 days, but don't be surprised if you have a lender tell you we need 40 days. And if they tell you they need 40 days, that's the way their business is built. That's the way their systems run. We need to put 40 days in here. But if it's going to be longer than 30 days, you need to understand your buyer is less competitive in today's marketplace. Okay. So you may want to have a conversation with them about changing to a faster, more nimble lender if we want our offer to be as competitive as possible. There are lenders out there that once you've established a relationship with them, you know them, you trust them. If they tell you they can do it in 21 days, which is something we commonly hear from Supreme Lending, and they've got a 98% close on time rate, no problems, no issues with you putting 21 days in here. Okay, but just make sure you have trust that that lender is going to be able to deliver on that commitment. 28 days is much safer. Okay, but buyers shall have 28 days from the binding agreement date to determine if they have the ability to obtain the loan. Okay, if they cannot obtain the loan, in order for our clients to retain their earnest money, there's a few things that need to happen. First, we need to notify the seller as buyer is terminating the agreement because buyer has been turned down for the loan. Okay, and that needs to happen in this time period. And provide seller within 7 days from the date of such notice a letter of loan denial from the mortgage lender based on the mortgage lender's customary and standard underwriting criteria. Meaning they have to have gotten turned down because of their credit standing, their debt to income, their ratios. They can't get turned down because they didn't get the lender the stuff that they needed. Okay, it can't be the buyer's fault that they got turned down. It has to be for standard underwriting criteria. Okay, and that letter that you send doesn't have to be within this time frame. The notice has to be within this time frame, the 28 days or the 35 days. We have to notify them we got turned down for the loan and we're terminating the contract. And then within 7 days of us providing that notice, and that 7 days could be after the end of this time period here, our 30 days from binding agreement date. But within those 7 days, we have to send them a letter. Okay. As we continue to move through, you're going to see there's a few things in here that are a little bit different than the conventional loan. The first place we're going to see a difference is in the amendatory clause. That's another name for our appraisal clause. Okay, a mandatory clause and appraisal clause mean the same thing. And what this paragraph tells us is that the buyer shall not be obligated to purchase the price or incur any penalty by forfeiture of earnest money unless the buyer has been given a appraisal setting forth the appraised value of the property of not less than, and we fill in the blank with whatever our contract price is. So we're buying a home for $267,000. Then we're going to put $267,000 in here. And that what this paragraph says is if our appraisal is not for $267,000, then the buyer shall have the privilege and option of proceeding. So they can go ahead and buy it. They have to pay the difference if they do that. But they don't have to. Okay, and they're able to shall not be obligated to complete the purchase described herein or incur any penalty. So the only rights this paragraph gives a buyer with the FHA loan, if we have a low appraisal, is to terminate the contract or to move forward and pay the difference. Now, in practicality, if the buyer and the seller are willing to agree to some other terms, a partial reduction in the sales price, a reduction of the sales price, but a faster closing or lower seller's contribution to closing, we can do that as long as everyone's in agreement, okay? But the seller's under no obligation to lower the sales price. The buyer has no right in the contract to reduce the sales price. They only have a right to terminate or to move forward. That's what's guaranteed in here. Can we try and negotiate? Yes. Okay. And you'll also notice the thing that's different about this amendatory clause from the appraisal clause in the conventional loan exhibit, it has no time limit. Okay. So this lasts all the way until the closing. Okay. So whenever that appraisal comes in, we're not stuck to a timeline. Moving on to the mortgage insurance premium, FHA charges the buyer for taking out an FHA loan. Okay, and that upfront fee is 1.75%, and we're either going to pay that at the closing table or we're going to add it to the loan and financed in. By far the majority of the time, 99.9% of the time, it's going to be option B. Okay. In paragraph 14, FHA requires that the seller pay the tax service fees. These are roughly $100, and what we're saying in here is that those costs are part of what the seller agreed on page 1 of the purchase and sale agreement to pay toward the buyer's closing cost, or they're in addition to the closing costs that the seller agreed to pay. Okay, so on page 1 of the purchase and sale agreement, we've asked that the seller pay $2,000 in seller's contributions to closing. Well, is this $100 fee part of that $2,000? Okay, or is this $100 being added to that $2,000 for what the seller has to pay? So not anything that I want to lose a contract over, but the are in addition to benefits the buyer, are included benefits the seller. Pick which one that seems most appropriate for you. Again, $100 when we're talking about a couple of $100,000 transaction, really a pretty trivial issue. Paragraph 15 addresses repairs that FHA will require. Now understand that the person that's going to determine if there's repairs that need to be made is going to be the appraiser when they go out. They're looking at the property not only to determine the value, but to make sure that FHA is happy with the condition of the property. Okay, and what FHA is looking for are things that are safety issues or are a threat to the property itself. Okay, so most appraisals don't have required repairs. The home has to be in a fairly bad shape or have some real issues in order for the FHA to step up and say, this has to be fixed or we're not going to make the loan. Okay, so we're asking in paragraph 15, and let me say this, that appraisal is taking place after we've done our inspection and we've negotiated repairs there. Okay, so this is not the same as our inspection, and it's certainly no substitute for the inspection that your buyer does. They're just looking for a small handful of issues that they deem to be important enough that they won't make the loan, not all the issues in the property. Okay, so but if the FHA does say this needs to be fixed or we're not writing the loan, what we're saying here in this paragraph is that the repairs shall be paid for by the seller, okay, prior to closing, provided such repairs do not exceed, and we're putting some dollar figure in here. So $500, $750, $1,000 are really common amounts that we see in there. And again, you use your judgment. If the home looks like there's a high probability that there may be some issues, put $1,000. If you think it's unlikely, put $500 in here. Understanding that this does not cost the seller anything if the FHA doesn't call out any repairs. This is only if they call out any repairs that need to be made. We're getting agreement from the seller right now that if we've got these couple of small things that need to be fixed that are less than this amount of money, they're going to agree to go ahead and do it right now if they come up. Okay. And I encourage you guys, you've got to go through and understand and read all of these things. For example, from a seller side, okay, when the seller accepts an agreement with an FHA loan, they are agreeing to pay for the cost of any lender-imposed inspections of the septic tank or well systems. Okay, so the seller's agreeing when they accept an FHA loan. So there's hidden gems like this throughout our contracts that you need to read through these and understand every element. Okay, but the next thing that we are filling out is whether or not the property may be obligated to connect to public sewer. Okay, the FHA prefers sewer systems over septic systems, and so if a property is on septic and sewer is available, okay, or if public water is available and we are on well water, okay, the FHA wants those connected to the public system. All right. So it's very rare that this is ever going to come up because two conditions have to exist. It's not on public water and not on public sewer, and public water and public sewer are available for that particular property. Okay. Usually if it's available, it's already connected. If it's not connected, it's usually because it's not available. So it's really rare this comes up. But in case it does, we are asking that the seller, and mark the checkbox, agrees to pay the cost of said connection not to exceed $500, $1,000. Okay, put those numbers in there. If you know that it is already connected to the public sewer and the public water, throw $100 in there. It's going to be a non-issue, and $100 in there is not going to intimidate anybody. And then paragraph 20, certify this is an arm's length transaction. We're either saying that it is an arm's length because there's no relationship between the buyer and the seller, or this is not an arm's length transaction because the seller is the buyer's brother. You know, describe whatever the relationship there is that makes this not an arm's length transaction. And then have everyone sign here. And guys, that's it for the FHA loan exhibit contingency. If you've got any additional questions, call me, text me, email me. Love to help you out. Have an awesome day.